Copper prices are quietly doing what oil did in the 1970s, exploding. Copper is trading near record highs, and the global copper market tied to the energy transition is heading towards the $1 trillion mark. But this isn't just a story about metal, it's a story about power. Every electric vehicle, every wind turbine, every solar farm, every upgraded power grid needs copper. Without it, the clean energy transition stalls, energy security weakens, and the global economy is exposed to a new kind of shock. Here's the problem. Demand for copper is surging, but copper mining supply is struggling to keep up. New mines take a decade to approve. Environmental rules, community protests, and political battles slow projects down. So the world is sleepwalking into a copper shortage. That copper shortage means higher manufacturing costs, more inflation pressure, and painful delays in renewable energy projects. Yet in the middle of this crisis, two countries are emerging as quiet gatekeepers, Canada and Chile. One controls massive reserves. The other controls trust, stability, and access to Western markets. Together, they are shaping who gets the copper and then who gets left behind. And that raises a bigger question. How did these two countries end up holding the future of the global energy system in their hands? Welcome to Geo Capitalist, the channel where we explore the strategic forces shaping our world. If you're new here, make sure to subscribe so you never miss the stories the mainstream outlets overlook. Now let's continue. Copper used to be just another commodity in the broader commodity markets. Now it's a strategic asset right at the center of geopolitical economics. To understand why, follow the numbers. Electric vehicles use up to 4 times more copper than traditional cars. Renewable energy systems need miles of copper wiring. Grid modernization, data centers, and AI infrastructure all lean on reliable copper supply. By 2030, analysts expect copper demand to jump by around 40%, driven largely by the clean energy transition and renewable energy investment. But copper mining output is not rising at the same pace. That mismatch is already driving copper prices higher and feeding into the inflation crisis. When copper gets expensive, it doesn't just hit miners and metal traders. It hits everything: EV prices, power bills, infrastructure costs. That's why governments now talk about copper the way they used to talk about oil, as a core pillar of energy security and national security. This is where resource nationalism kicks in. Countries with serious copper reserves are rethinking how much foreign investment they accept, how much they tax, and who they sell to. And sitting right at the intersection of critical minerals and global power are Chile and Canada, each playing a very different but equally important role in this copper rush. Chile is the undisputed heavyweight of copper. It controls close to a third of the world's known copper reserves and remains the top producer on the planet. If copper is the new oil, Chile is the closest thing we have to a copper Saudi Arabia. For decades, Chile turned copper into the backbone of its economy. Massive foreign direct investment flowed into copper mining in the Atacama Desert. Global mining giants and Chinese state-backed companies lined up to secure long-term supply deals. But Chile was never just selling off its resources blindly. The state kept a firm hand through regulation, taxation, and in some cases, state-owned companies. This gave Chile leverage in the global copper supply chain while still attracting foreign capital. There's a catch, though. The Atacama Desert is facing water scarcity, environmental damage, and local resistance. Communities are pushing back against large-scale copper mining. Politicians are debating higher taxes and tighter rules. That adds risk and uncertainty to future production. Yet despite these challenges, the world still depends on Chilean copper. Any disruption there can send copper prices soaring and shake the global economy. That dependence gives Chile quiet influence over the timing, cost, and pace of the global energy transition. But Chile isn't alone anymore. Another player is moving up the board. On paper, Canada doesn't match Chile's gigantic copper reserves. But in the game of strategic minerals and energy security, reserves are only half the story. Canada offers something investors and governments value even more: stability. Strong institutions, clear regulations, predictable courts, and relatively low corruption. In a world worried about supply chain risk and political shocks, that makes Canadian copper extremely attractive. Canada is branding itself as a trusted hub for critical minerals. Not just copper, but nickel, cobalt, and rare earths tied to the energy transition. Western governments want secure supply chains that don't run through unstable regions or geopolitical rivals. Canada fits perfectly into that strategy. At the same time, Canada is moving beyond just digging ore out of the ground. It's investing in refining, processing, and advanced manufacturing linked to clean energy infrastructure. That means more value captured inside Canada and tighter integration with allies like the US, the EU, and Japan. Each new copper mine, each critical minerals deal, is also a diplomatic tool. Supply agreements can lock in long-term partnerships on technology, defense, and trade. So while Chile projects power through sheer volume, Canada projects power through trust, rules, and alliances. In a deglobalizing world, that combination is becoming incredibly valuable. Behind the headlines about copper prices, a massive investment war is unfolding, one that will shape the global economy for decades. Sovereign wealth funds, pension funds, and state-backed investors are all racing to secure stakes in copper mining, copper refining, and infrastructure linked to critical minerals. They're not just chasing profits, they're buying security. China has been ahead of the curve here. Chinese firms, often backed by cheap state financing, have spent years acquiring copper mines around the world and building dominance in processing capacity. That gives Beijing enormous leverage over the energy transition supply chain. Now Western governments are trying to catch up. They're pushing their own companies and funds to invest in friendly jurisdictions, and that's where Canada and Chile come in. Chile offers scale. Canada offers safety. Both attract foreign investment, but both are also tightening control. New rules around environmental standards, indigenous rights, and national interest reviews mean not every deal gets approved. The stakes are huge. Mines approved today will still be producing copper in the 2040s. Processing plants built now will decide who controls the most profitable links in the supply chain. In other words, this isn't just about who makes money from copper. It's about who sets the terms of the global energy transition itself. When one resource becomes this important, it also becomes an asset. Copper is now deep inside the geopolitics of supply chains, sanctions, and trade wars. Imagine a political crisis in Chile that shuts down major copper mines, or new environmental regulations in Canada that delay key projects. Instantly, copper supply tightens, copper prices spike, and the cost of renewable energy projects and EV production jumps. Now layer in global rivalry. China's dominance in copper processing means that even if Canada and Chile mine the ore, a large share may still need to pass through Chinese-controlled facilities. That creates a single point of failure in the critical minerals supply chain. Western governments are responding with new policies to de-risk supply chains, encouraging more local processing, stockpiling critical minerals, and funding alternative routes. But building new refineries and smelters is expensive and slow, so copper is turning into a pressure point in geopolitical economics. It can be targeted with export controls, used as leverage in trade negotiations, or pulled into sanctions policy. For investors and policymakers, copper is no longer just a line on a commodity markets chart. It's a strategic vulnerability, and that makes Canada and Chile even more important in global calculations. It's easy to treat copper as an abstract market, but copper shortages don't stay on spreadsheets, they hit everyday life. If copper supply can't keep up with the energy transition, EV production slows, waiting lists get longer, prices stay higher. Renewable energy projects are delayed or downsized because grid upgrades become too expensive. That stalls the clean energy transition and keeps fossil fuel demand higher for longer. Higher copper prices feed into broader inflation. Infrastructure projects cost more. Governments have to spend more to build the same roads, power lines, and data centers. That can mean higher taxes, more public debt, or delayed investments. For the global economy, that's a dangerous mix. Energy insecurity, slower decarbonization, and persistent inflation. The exact scenario central banks and policymakers want to avoid. In that context, every new copper mine approved in Canada or Chile, every processing facility built outside China, becomes a small step towards stabilizing the system. But there's no guarantee it will happen fast enough. And that's where the real power of Canada and Chile comes into focus. Who really controls the future? Step back and look at the map. Two countries on opposite ends of the Americas now sit at the crossroads of the energy transition. Chile, with its vast copper mining reserves, and Canada, with its trusted role in critical minerals and secure supply chains. Together, they don't own the future, but they do control key bottlenecks that everyone else has to move through. Car makers, tech giants, renewable energy firms, and even governments are all in some way exposed to decisions made in Santiago and Ottawa. Will Chile push further into resource nationalism, raising taxes and tightening control? Will Canada speed up approvals for new copper mining projects and processing plants, or get bogged down in politics and regulation? Those choices will ripple through energy markets, the global economy, and the pace of the clean energy transition. So the real question is this: in a $1 trillion copper rush, are Canada and Chile simply reacting to global demand, or quietly writing the rules of the next energy era? Let me know what you think in the comments. Are we underestimating how much power these two countries now have over our energy future? And which resource should we break down next in this new map of global power? And there you have it. If you gained clarity today, I invite you to watch the next video, because the world is shifting fast, and every alliance tells a story. Remember to like, share, and subscribe. Your support helps this channel continue delivering fact-based analysis. Thank you for being here. See you in the next video.